Hello, this is Colleen Martelli, and we are going to be discussing today planned giving. What are the types of planned giving and how does each work? Planned giving, one type is deferred gifts of cash. This is a planned gift type where the non for profit organization receives the donation after the donor passes away. They are simple to give in that the donor names the non for profit as the beneficiary to part of their estate or their retirement account. There are several different ways to implement deferred gifts of cash system. We have the bequest system. This is where the donor allocates a portion of his estate to the non for profit organization in a legal will. This is great for the donor as it doesn't cost him anything during his lifetime. Another way is called the retirement plans and life insurance. This is where the donor names a non for profit organization as a beneficiary to his life insurance policy, his 401k, 403bs, or pensions. This can significantly impact the organization because they are generally large contributions. Then we have the planned gifts that pay income. This type of gifting requires a long relationship between the donor and the non for profit. The non for profit organization generally receives a large donation of investments, funds, and pay income to the donor for life. Charitable gift annuities is one example. The donor gives an irrevocable gift of cash to a non for profit in exchange for fixed income payments for a set term or for life. When the donor passes up or the term is up, the profit gets the leftover cash. Some donors defer payments until their retirement is so they can receive higher payments. Charitable gift annuities trust that a smart action for donors who want to give a large donation yet protect their income. And then we have the charitable remainder annuities trust. In this case, the donor contributes cash or appreciated securities and receives a fixed income based upon a percentage of initial assets used to fund the trust. And then we have proof of income funds. Pooled income funds is, in this case, the pooled income funds of the donor can see an immediate tax deduction and avoid capital gain tax on any appreciated assets that they contribute. The charitable funds are pooled together for investment purposes. Then we also have something called planned gifts that protect the donor's assets. Charitable lead trust, where the donor makes a gift through charitable lead trust through the non for profit, and the non for profit gets a fixed income stream. These trust leads are excellent way for the non for profits to ensure a set amount of funding income each year. Then we have the retained life estates, where the donor transfers a property deed to the non for profit while retaining right to use the property until the term is up. Then the property goes to the non for profit to be used as they see fit. The donor benefits from this form in that the charitable donation reduces estate taxes for the donor and income tax reduction, and it simplifies their estate planning. What are the 5 benefits for planned giving? Well, it secures organization future. It secures and the gifts are usually large amounts. The cost is very little to secure, and they offer a high return for the investor. You can also increase annual giving, and it brings power and gifts to the donor. It opens up the door for more gift giving. Once the donor has made a donation, there will they will begin to think beyond cash gifts. What are other benefits? The donor creates a legacy for themselves and for their families by making a lasting impact on a cause that's important to them. Donors can secure tax benefits such as a reduction in federal estate tax and tax-free gifts from IRAs. Donors can also determine how their gifts are spent depending on the organization, and they can update their will and determine where the donation can make the most impact. What are some important issues involved in taxation of major gifts. We have tax exempt organizations that are subject to tax on income from businesses' activities that are unrelated to the exempt purpose. This tax is known as unrelated business tax income. Additionally, the tax exempt must pay the same employment tax as for the profit employees as well, and they file other tax returns such as an excise tax return. A contribution of appreciated assets having particularly beneficial treatments can be deduced, excluding the capital gains income that would be subject to taxation. Gifts of appreciation of property are generally subject to lower deduction limits. Corporate charitable contributions are generally limited to 10% of the corporation taxable income. What are the pros and cons for planned giving? Well, you receive a large amount of gifts. You have a consistent stream of gift donations. Planned giving also offers a tax advantage for donors and consistent income for the organization. Planned giving gives program The planned giving program isn't as complicated or time consuming as one may think. The cons are non-for-profits would have to wait several years before the money would be available for use. Another con is the planned giving program process takes a great deal of planning and foresight. And it also takes a little time to set it up. Giving the planned giving program takes a while to set up. And board members of the non-for-profit organization may be resistant initially when they hear about the idea of planned giving program.